Alphanomics, the informational underpinnings of market efficiency, delves into the complex dynamics that drive financial markets, particularly focusing on how information is processed and reflected in asset prices. The book scrutinizes the concept of market efficiency and the role of arbitrageurs, investors, and analysts in contributing to or undermining this efficiency. Here's our pick of the top 10 insights from the book. 1. Markets harness the collective intelligence of investors, often making them more accurate at setting prices than any individual alone could be. Imagine the stock market as the world's wildest, most unpredictable potluck dinner. Investors arrive lugging their Tupperware containers of information, insights, and intuition. When each dish of data is added to the collective buffet, a more nuanced and layered financial feast unfolds. So when Mr. Market rings the dinner bell, rather than the chaotic food fight one might expect, what emerges is a surprisingly well-seasoned dish of prices that often reflect the true taste of the underlying assets. This doesn't mean there won't be an occasional misjudged jalapeno that sets everyone's mouth ablaze, but for the most part, the wisdom of the crowd is the secret sauce to market efficiency. Bon appetit, investors. 2. Information asymmetry is not necessarily detrimental to market efficiency, as it can incentivize the production and disclosure of information. Consider this. Information asymmetry, often vilified as the arch nemesis of market efficiency, is actually the unsung hero that fuels the intellectual scavenger hunt on Wall Street. It's what gets analysts out of bed in the morning, eager to dig through the data dirt and unearth precious informational nuggets that the rest of us mere mortals have overlooked. It's the carrot dangling in front of the savvy investor's nose, luring them into crafting beautifully intricate models that could predict how many lattes will be sold on a rainy Tuesday. Without it, the market's informational garden would wither. No one would toil in the fields of fiscal fact-finding. Essentially, a pinch of information asymmetry adds the spice that keeps the capitalistic feast flavorful and everyone at the table. 3. Traditional financial models may overlook the role of non-financial information, such as corporate culture and social capital, in driving market outcomes. Consider the financial wizards of Wall Street, furiously crunching numbers with furrowed brows. Now imagine them pausing, perplexed by the buoyancy of a stock unexplained by their spreadsheets. This comical dissonance lies at the heart of our insight. Financial models, in their stoic elegance, often snub the juicy gossip of the office hallways, the collective employee eye rolls, or the viral TikTok that unwittingly shapes corporate rep. Such non-financial fairy dust sprinkled liberally over the ledgers can turn market pumpkins into carriages, reminding us that sometimes the cogs of the market wheel are greased not with oil, but with culture and social vibes. 4. Market efficiency doesn't imply that prices are perfect, but that they reflect all available information, including the diverse interpretations by market participants. Sure, let's dive into the financial deep end without floaties. Market efficiency is like having everyone at a potluck dinner contribute a dish. Everything on the table is what's on offer, but that doesn't guarantee every dish is a Michelin star creation. Similarly, in markets, the current stock prices are the smorgasbord resulting from all the public gossip, data crunching, and gut feelings investors stir into the pot. The beauty of it is that for every investor who brings a spicy buy hot take, there's another with a sell recipe that's more conservative than grandma's meatloaf. The market chows down on these and sets prices that reflect the full buffet of information's flavor, including the nutty and the half-baked. 5. Behavioral biases in investors can both contribute to and correct market inefficiencies, providing a dynamic balance between rationality and irrationality. Picture the stock market as a disco ball. Those investors? They're the glittery bits reflecting light with every irrational shimmy and shake. Each investor's little bias boogie, be it overconfidence, herd behavior, or loss aversion, adds a unique twist, sometimes throwing the market into a funky groove of inefficiency. But brace yourselves for the twist. These same dance moves that trip up the market can also help it find its rhythm again. In this dazzling dance-off, rationality and irrationality tango, keeping the disco of market efficiency alive with electric energy, showcasing a fascinating paradox where inconsistency is the only consistent partner on the floor. To sum it up, Alphanomics, the informational underpinnings of market efficiency, explores the complexity of financial markets, arguing that efficiency is a product of both the collective intelligence of investors and the role of informational diversity, including non financial factors and behavioral biases. The book challenges traditional financial models and offers a nuanced view of how information asymmetry and investor behavior shape market outcomes. Thanks for watching.